Well, hey there, everyone. Happy Tuesday. Hope you're having an awesome day. I am super pumped to be here for our Tip Tuesday. Today, we are going to talk about the tax impacts of 2020 because let's be honest, 2020, a lot happened. And a lot happened in many different ways, but all of those things potentially have tax impacts for us. So we're going to go through some of the big ones today, some of the ones that you may be surprised by, you may not be aware of, and just in general, kind of what to expect when you go to file your 2020 taxes and how these changes may impact you. So I'm going to go ahead and pop up our slides here. If y'all have questions as I go through this, definitely let me know. I'm happy to answer them. And also let me know who's here. I always love to know who's watching us live. So let me pull up our slides here. All right, perfect. What do we got? Excellent. There we go. So 2020 tax impacts I'm saying for business owners, some of these are going to be applicable whether or not you own a business, but obviously, since most of us here are business owners, I really wanted to tailor these to y'all's situation. So, hold on. Now it's not going to let me change my slide. Hold on. There we go. Cool. So the first one I want to chat about are those stimulus checks. So you may recall getting a check for $1,200 or $600 or some amount, maybe up to those numbers. Everybody's calculation was based off of your prior year tax returns because we hadn't filed our 2020 taxes yet. And so you may have received an amount from the government. You may have received two payments. There were two rounds of stimulus so far. You may have received amounts for your dependents, for your kids if you have them. So you may have gotten checks. And these sort of economic stimulus checks were a big part of the CARES Act and a big part of the financial benefits that the government provided last year. Well, the good news is these stimulus checks are not taxable income. So you don't have to pay tax on these, which is a good thing. So enjoy that win. So there is, however, something to know with these stimulus payments. If you didn't receive the full amount, or if you didn't receive a stimulus check at all, there is something called the Recovery Rebate Credit. And this credit essentially allows you to claim those missing economic impact payments. So remember I said that the amount the government sent you was based on your 2018 or 2019 tax returns because you hadn't filed 2020 yet. Well, if you didn't qualify for stimulus payments because your 2019 income was too high, but you would qualify based on your 2020 income, then you would be able to use this recovery rebate credit to get that stimulus money that you didn't get, but you, in fact, are entitled to. So that happens on your tax return when you file for 2020. You'll just want to make sure you fill out that form so that you can go ahead and get that stimulus money. So we're starting off with good news. So on the flip side, if you got unemployment benefits, those unemployment benefits are taxable income. And this is one that I actually think is going to surprise a lot of folks because a lot of the states don't actually withhold taxes when they pay out those unemployment benefits. I know here in Massachusetts, they don't, at least not automatically. And it really wasn't obvious that they don't. And there wasn't really a good mechanism to say, hey, I want you to withhold taxes. Other states do this automatically, which is really nice. And then states will have the option to have taxes withheld. But again, the sort of degree of obviousness ranges from state to state. So some states make it very blatant, like we don't withhold taxes, check this box if you want us to. Others just really didn't talk about it at all. So if you got unemployment benefits, they are taxable income to you in 2020 or in any year. This isn't COVID specific, in any year. And you may end up owing some tax if you didn't have taxes withheld from those payments. You should have received what's called a Form 1099-G from the state. And this will give the amount of the unemployment benefits that you received, and it'll also give you the amount of taxes that they withheld. So make sure you look for that form. If you don't have it, call your state's unemployment division to try to figure out what happened to it. But that's the form you're going to need, and that's the form that's going to give you this information. So if you were paid unemployment benefits and you didn't have taxes withheld, be prepared. You might end up owing a little bit of money. Now, the Paycheck Protection Program is another one that folks ask about. So this was, just as a reminder, this was a loan that business owners could get essentially to cover payroll costs for their employees while their business was affected by COVID. And you could use it for a few other things as well, but that was the general gist. The big benefit of the PPP program is that as long as you follow certain rules, you use it for certain expenses and whatnot, then you could actually get 100% of the loan amount forgiven. So effectively, it becomes a grant. Now, typically when we have a loan that's forgiven or when we get a grant, that money is taxable income. It's just generally the case. But Congress did come out and say that with the PPP loan, that loan forgiveness is not going to be treated as taxable income. This is another big benefit coming out of last year. So if you got PPP funds and you do have them forgiven, whether it's in 2020 or 2021, because when you get your loan forgiven, kind of depends on a few things and when you apply. But regardless of what year you get that loan forgiveness in, it's not going to be taxable income to you. And what's even better, this is actually like a double benefit. What's even better is you can deduct eligible expenses. So you're going to get those loan funds, you're going to use them to pay for, rent and payroll and utilities. You can actually take a tax deduction for those expenses, even though you're not recognizing the income from the loan forgiveness. So this is a win all around if you did the Paycheck Protection Program. Okay, so let's talk about the EIDL, which is the Economic Injury Disaster Loan. And there was also an advance. Some of you got this, I know, where essentially they would, if you applied for the loan, they would give you up to $10,000. That was essentially a grant. You didn't have to pay it back. That portion wasn't a loan. If you then went on to get the full EIDL, the full Economic Injury Disaster Loan, that was a loan and there's no forgiveness or generally no forgiveness element to that. But the EIDL advance, the up to $10,000, is not taxable income. So that's another piece of good news. And the EIDL loan itself is not taxable income because it's a loan. There's no loan forgiveness, so there's no income to you. There's one other portion, I don't actually have it on this slide, but I wanted to bring it up because it actually came up with a client of mine recently. If you have just a regular SBA loan, so not an EIDL, but you had an SBA loan, a loan from the SBA prior to COVID hitting, under certain circumstances, Congress, as part of their COVID sort of financial package, added in a component that essentially said the SBA will pay 6 months of your payments on that loan. So basically they'll forgive 6 months of payments on that loan. It was for, again, loans that were existing pre-COVID. There were certain requirements in order for your loan to qualify, but it happened automatically. So you didn't need to do anything to qualify. If that happened, if they essentially forgave your loan, or made those payments for 6 months, that is also not taxable income. So good news there as well. We don't need to subject that income to tax. Now, expenses that you pay for with your EIDL loan funds are tax deductible under the regular rules. Again, it's a loan, so completely tax deductible as long as they would normally be under the regular rules. Okay, so retirement distributions. This is one, I know a few folks took advantage of this. So again, as part of the COVID financial relief package, they basically have waived the early withdrawal penalties on distributions from retirement accounts. So normally if you take a distribution from your retirement account before you're a certain age, usually 59 and a half, then you'll have to pay, you'll pay income tax on that money, but you'll also have to pay an early withdrawal penalty. So that has been waived if you took money out of your retirement account in 2020 for COVID-specific reasons, and there's like a very specific list. So as long as that applies, you don't have any early withdrawal penalties on those distributions. Now, those withdrawals do count as taxable income, so you still have to pay tax on them to the extent that they would normally be taxable. It depends on the retirement account you have, whether you put pre-tax contributions in or post-tax contributions in. But just note that you will still pay income tax on those. Now, if you took money out because of COVID and you actually return the funds within 3 years, you will get a refund on those taxes paid. So they've essentially set it up to where you could kind of loan yourself the money, if you will. And as long as you pay it back within those 3 years, you're not going to pay income taxes on those withdrawals. There's a bit of a timing issue there because you do have to pay it now if you haven't paid yourself back, but you will get it back when you do ultimately pay those retirement distributions back. Okay, so let's talk about the home office deduction, because this is a deduction that always exists, but it's one that I think is going to be even more applicable this year. So the home office deduction normally essentially entitles folks to take a deduction for the use of a space in their home for business purposes. Now, to be very clear about this, you've got to be self-employed to take this deduction. So if you are an employee of a business and you know in 2020 you had to work from home because of COVID, you cannot take this deduction. This deduction is solely for self-employed folks. The space itself has to be a dedicated workspace. So it does not need to be its own room, but it's got to be its own clearly delineated space. So you can't do like the kitchen table or your living room sofa. It's got to clearly be a workspace. It's got to be used 100% for business. And it also has to be used regularly for business. So the example I will always give is if you didn't work at all last year, except for 1 month in the summer, you decided to work. And for that 1 month you used your home office, you really can't take that home office deduction because it's not something you used regularly throughout the year. So assuming you do qualify for the home office deduction, then you can take a percentage of your mortgage interest, your rent, your utilities, repairs and maintenance that are applicable to the space. You can take a percentage of those as a tax deduction on your return. What else was I going to say about that? Oh, yeah. And actually, one other thing I'll mention, just for folks who maybe aren't familiar with the deduction, is there are actually two ways you can calculate that. So you can look at actual expenses, like I just described, and take, again, a percentage. So if your home is 1,000 square feet and your home office is 100 square feet, 10%, you would take 10% of those bills. The alternative method is to take the standard home office deduction rate, which is $5 per square foot. So you can do either one of those options. But I do just want to reiterate that you cannot take a deduction for the space if your kids used it for homeschooling or your spouse used it for their employer job. It's got to be a space that's used 100% for your business. And for my folks who are S Corp folks, you might be thinking, well, hold on, I'm an employee of my business, so am I not allowed to take it? And it gets a little more complicated than that. Talk to me or talk to your accountant if that's you, because in that case, potentially you can take it. We just have to structure it a little bit differently. Charitable contributions. This is one that has changed a little bit this year. So generally, you cannot deduct charitable contributions if you take the standard deduction. You may know that you have the option on your personal return to take the standard deduction, which is about $12,000 for single folks, $24K for married, or itemized deduction. An itemized deduction would be adding up all of the expenses of your mortgage interest, your property taxes, your medical expenses, your charitable contributions, plus a few other things, and you can take which one is bigger. That's not a business-specific thing. That's something available to every individual who files taxes. But generally, you can't include those charitable contributions unless you itemize. In 2020, as part of the COVID financial packages, Congress passed a rule that says for 2020, you can deduct up to $300 in cash contributions to qualified nonprofit organizations, whether or not you itemize. So even if you take the standard deduction, you can potentially deduct an additional $300 for charitable contributions if you made them in 2020. I want to be clear, this is not contributions to political organizations, because obviously there was a lot going on last year with politics. Unfortunately, those are not tax deductible. It's just going to be to qualified nonprofit organizations. And now in 2021, they've decided to extend it, and the deduction was actually doubled to $600 if you're married filing joint. So it's still $300 if you're single. It's now $600 if you're married filing joint. This is a big one that throws a lot of people off. So if you worked out of state at all in 2020 or 2021, for example, if you decided to go to your parents and work there for a few months, or if you have a vacation home or a second home and you decided to go there and work for a few months, a lot of people fall under this bucket because of COVID. They ended up going to kind of stay or live somewhere else. If that's the case, you may be subject to taxes in the state where you ended up working, and you may have to file a tax return in this state. Now, this slide actually says if you worked remotely for more than 183 days, but I'll be honest, there are actually a lot of states where that threshold is even lower. So I would highly recommend for whatever state you ended up working in that you look up their rules, talk to your accountant if you've got one to help you with this. There are some states where if you worked there for even a day, you could be subject to tax in that state. There are others that are much more lenient, and they do that 183 day rule. So just check it out, but note that this is something that's going to catch a lot of people this year, because a lot of folks were working in other states, and most people don't even think about this as something to be aware of. Now, you might be thinking, well, hold on, does that mean that I don't then file in the state that I live in? And the answer is no, you actually have to file in both. You have to file in your state of residence, and you also may have to file in the state you worked. So then the next question is, well, hold on, does that mean I'm going to be subject to double tax? And the answer is yes, sort of. You are kind of at the beginning step, but a lot of states have mechanisms in place to prevent that from actually happening. So some states have reciprocal agreements. So for example, New York and Connecticut have this. If you live in one state and work in the other, they're not going to double tax you. Other states have they'll have basically credits, tax credits for taxes paid to other states. So if you pay tax to a different state and you have to pay tax in your own state on that same income, you'll get a credit for the taxes you paid to that other state. It doesn't always work out perfectly net, because the credit is oftentimes there are limitations on how much credit you can take. Some states will say you can't take more of a credit than our state's income tax rate, things like that. But usually it'll help you out. So states that have that, that's a good thing as well. And then even other states have rules that are called for the convenience of the employer rule. So essentially, they will subject you to tax in the state where the employer is located. And so for those of us who are self-employed, that's usually going to be our state of residence. So just note that this is potentially an issue if you worked out of your own state at any point during 2020 or 2021. Hey, Renata, thanks so much for being here live. So let me pull back over here. Let's head to that next slide. Okay, payroll tax deferral. Not a lot to say on this one, but if you are a small business, you potentially have the option to delay the employer portion, so your portion of your federal payroll tax payments for the next 2 years. So if you have employees, you had this option, and I actually think you still have it for a couple more months, or maybe a month. So it's an option. Keep in mind, delaying doesn't mean you don't ever have to pay. So really, this is just to help you free up some cash flow now. But just keep in mind that if you do this, this will still leave you with that payroll tax liability down the road. There is a tax credit called the Employee Retention Tax Credit, and I think a lot of folks may be interested in this one for 2020. So this tax credit is available if your operations were either fully or partially suspended because of COVID-19. So typically this would be if there was a shutdown order, or something in your state where they said your type of business can't operate. But you can get this credit if you continue to pay your employees while your operations were fully or partially suspended. So the credit is 50% of up to $10,000 in qualifying wages for each full-time employee. So it's potentially a $5,000 credit per employee, depending on what you pay your folks. Of course, there are a bunch of rules about exactly who can take it and exactly how you calculate the credit. So again, work with your accountant or look on the IRS's website for more guidance, but this could be a really great credit if you have employees and you continue to pay them while your operations were suspended. Another really important credit to be aware of is the paid sick leave credit. And this actually, this can benefit you whether or not you have employees. We're going to talk about employees first, and we'll talk about self-employed folks second. So the Families First Coronavirus Response Act, so FFCRA, required many businesses to provide sick leave to employees who were absent for COVID-related reasons between March 31st of last year and December 31st of last year. So you're required to provide this sick leave. So if somebody had to be out because they got COVID, or they had to quarantine, or they had to take care of a family member who had it, you were required, many businesses, not all businesses, but many businesses were required to provide paid sick leave for those folks. So if that was you, you can take this credit for what you paid. And the credit is 100% of the cost of that sick pay that you paid. Now, you actually don't get the credit on your 1040 or your individual tax return in April. You get it on Form 941, which is where you report those qualified wages. They have also extended the credit through March 31st, 2021. So it's no longer required to provide the sick leave, but if you choose to voluntarily provide it to your employees between January and March 31st of 2021, then you can take the credit as well. So really good if you've got employees and you were required to provide that sick leave. Now, for self-employed folks who maybe don't have employees, there is also a credit for you under the same paid sick leave provision. So it's a refundable credit, which, by the way, that's a really good word, because what that means is even if your tax liability is otherwise zero, you'll still get cash for the credit. So that's what refundable means. Non-refundable means you only get the credit to the point where your tax liability is zero. So it's a refundable credit, and essentially it's 100% of your qualified sick leave equivalent amount, which I'll talk about in a second, and your self-employment tax based on that amount. So essentially what they needed to do, since you didn't probably pay yourself for the time you had to be out, is the IRS needed to come up with a formula for how to determine what your wages were during that period of time. So that's the qualified sick leave equivalent amount. And it's determined basically by the number of sick days that you were out and also the reason you were out. So there's a different calculation for if I was out because I myself was sick versus if I was out because I was taking care of someone, a family member. Now, you do have to reduce the equivalent amount if you also work as an employee and you receive wages by an employer who is claiming credits under the FFCRA. So if you've got a wage job and you are self-employed, you may have to reduce the credit that you're entitled to. The credit gets claimed on Form 7202. So if you think that this is going to be something you can qualify for, make sure you include that form with your return. Remember I mentioned that qualified sick leave amount is going to be different. So here is the breakout. So if you were on sick leave for yourself, you must have been unable to work due to a federal, state, or local isolation or quarantine order, advisement from a healthcare provider to self-quarantine, or symptoms of COVID-19 leading you to seek a medical diagnosis. So you can't just have said, oh, I feel sick, I'm out. You have to meet one of these criteria. And if you do, the credit is the number of days that you were out sick on sick leave times the smaller of your average daily self-employment income, which is all of your self-employment income divided by the number of days in the year, or $511. On the flip side, if you were out on sick leave to care for a family member, it must have been because you were unable to work due to either caring for someone who is under a federal, state, or local quarantine or isolation order, or caring for a child due to school or daycare closure. The credit in this case is the number of days you can't work times the smaller of 2/3 of your average daily self-employment income for the taxable year, or $200. So there is a potential credit for you, but just note that the way we calculate it can be a little bit different depending on the exact situation. Okay, so that's it for the changes in 2020. I know I said that's it. It was a lot of big changes. I think the biggest takeaway for everyone to keep in mind is just that a lot shifted in 2020, and a lot of things that are normally the case. Loan forgiveness is taxable income. Grants are taxable income. Things like that are not going to be the case necessarily in 2020 because of the rules that Congress passed specifically on certain items. So my biggest piece of advice to you is if you had some of these things go on, talk to an accountant, hire someone to do your taxes, because if you're going to do it any year, this is a good year to do it, because you really want to have someone who understands these tax law changes working on your information for you. As I pointed out, there are a bunch of different credits, and if you try to do it yourself, you may not end up taking full advantage of everything that's out there, or even worse, you might misreport something or report it inaccurately and then get a notice or end up facing fines and penalties down the road if you treated something incorrectly. So that's my big takeaway to you. I'm normally not that pushy about hiring an accountant, but I think if you're gonna do it any year, I would definitely do it in 2020 to have someone take care of your taxes for you. Hopefully that was helpful. Please let me know if you have any questions for folks who watch this on the replay. Drop them in the comments. And remember, I'll be back here on Thursday for our weekly Q&A. And just as a reminder, I think I only have maybe 1 or 2 spots left, but I have just a couple of spots left in my 2020 and 2021 Done For You tax prep package. So if you want that support, if you want someone who understands the tax law changes, you don't want to worry about taxes this year, head to megkwheeler.com/tax to learn more and grab your spot. Renata, thank you so much. So glad you liked it. And I'll be back here on Thursday for our Q&A. Bye for now.